Another instance that causes partnership dissolution is the incorporation of a partnership. When a partnership is converted into a corporation, the partners' relation changes. They cease to be partners and become stockholders. There are various reasons for incorporating a partnership, which may include the following. First, limited liability of shareholders. Shareholders are not liable to corporate creditors beyond their investment in the corporation. And then secondly, the ease of raising additional capital. Greater capital can be raised through an increased number of owners. Also, it is easier for a corporation to generate external financing, as lenders need not worry about the death of the partners. Privacy and confidentiality. Unlike in partnership, the owners of a corporation are not agents of the corporation. Next, dispersion of risks. The risk of loss is dispersed to more than one owner. Unlimited life. The changes in the relationship of the owners of a corporation do not dissolve the corporation. Although, in Philippines, there is a maximum life of 50 years, but this can be renewed upon expiration. Then we have transferability of ownership. Ownership interest in a corporation can be easily transferred through sale of shares of stocks, and this does not dissolve a corporation. And lastly, better public relations. Many believe that wider ownership of a business results to better public relations. When a partnership is converted into a corporation, the corporation acquires the assets and assumes the liabilities of the partnership. In return, the corporation issues shares of stocks to its owners. Okay, so to illustrate incorporation of a partnership, let's answer the following problem. ABC Partnership is converted to a corporation on January 1, 20X1. Relevant information are as follows. Additional information, equipment is valued at 220,000 while only 80% of accounts receivables are estimated to be collectible. Inventory could be sold for 60,000 and the corporation's authorized capital is 1 million pesos divided into 50,000 ordinary shares with par value of 20 pesos per share. First requirement, assume that shares to be issued to partners are based on their adjusted capital balances. How many shares would be issued to each partner and provide journal entries. So to answer this problem, let's compare first the book value of the net assets as well as the fair value. So these are the book value and these are your fair value. So for cash, of course, the face amount will be the fair value. So this is 40,000. For inventory, we have 60,000. For accounts receivable, so only 80%. So 80%. We have to compute 80%. 80% times 120,000, that will give us 96,000 pesos. So this is 96. And for the equipment, okay, 220,000 is given. So we have 220. By the way, the book value is 200,000 only. Of course, the net amount. So now, let's compute the difference or the changes. So for cash, of course, no difference. For inventory, there's been a decrease of 10,000. For accounts receivable, for accounts receivable, decrease of 24,000. And lastly, for equipment, okay, the difference is 30,000. 20,000, sorry. And it's an increase. So the net difference is, so negative 10 minus 24 plus 20. So this is negative 14,000. So this difference, this revaluation of net assets shall be distributed to the partners' capital accounts. Okay. So partner A, B, and C. Total. Okay, so we have 90,000, 80,000, and 120,000. So for a total of 290,000. So these are the capital balances. Okay, and then for revaluation, so 14,000. This 14,000 will be distributed in the ratio of 3:3:4. Okay, so 14,000 times 30%, 4,200. Negative, of course. 4,200 also. And 14,000 times 40%. So this is 5,600, which is also negative. Okay, so these are the adjusted capital balances. Okay, so let's compute. This is 85,800. This is 75,800 and 114,400. Okay, for the total, it will be 276,000. Okay, so since the par value is 20 pesos per share, so we have to divide this by 20 to determine the number of shares to be issued to each partner. Okay, so 85,800 divided by 20, so this is 4,290. So this will be your number of shares. And then 75,800 divided by 20, 3,790. Lastly, 114,400 divided by 20, so this is 5,720 shares. And to compute for the total, so 276,000, we can also divide this by 20. So divided by 20. Okay, so the total number of shares to be issued to partners is 13,800. Okay, so that's it. That's the number of shares. So provide journal entries. So, okay, in the partnership books, this will be the entries. Okay, so first, we have to update the fair values of all the net assets of the partnership. Okay, so we have inventories. So that's a credit to inventories, 10,000. And then for accounts receivable, 24,000, decrease also. Whereas for equipment, positive, amounting to 20,000. Okay, and then we have distributed this revaluation to each partner. Okay, so we have A capital, B capital, and then C capital. Okay, so we have 4,200, 42, and 56. Okay, so this is to update the fair values. Okay, next, second entry, of course, is to close the partnership books. Okay, so to close the partnership books, all assets should be derecognized as well as the liabilities and close to the capital accounts. Okay, so we only have one liability account, and that is accounts payable. So 140,000. So here we have accounts payable 140,000. So of course, we're going to close all the capital accounts. So A capital, B capital, and then lastly C capital. So of course, this will be based on the adjusted. So the adjusted capital balances are 85,800, 75,800, and 114,400. So 85,800, 75,800, and 114,400. Then we close all the assets. So cash, this is 40,000. Okay, so 40,000. And then inventory 60. Accounts receivable. Okay, so we have 90, 96. For equipment, okay, so there is an increase of 20,000. Okay, but there is a contra asset account which shall be closed also. So that is 250 plus 20, so that will give us 270. And then the accumulated depreciation is 50,000. Okay, so accumulated depreciation is 50. And so that's how we close. Okay, so accumulated depreciation and equipment, of course the net amount should be 220,000. So to close the books of partnership, okay, now, so the first entry for the corporation will be as follows. Corporation books. Okay, so of course the corporation needs to recognize all the net assets at fair value. So we have cash, inventory, AR, and PPE. Okay, so we have 40,000. Merchandise inventory 60. For accounts receivable 96. And for PPE 220,000. Net amount. Okay, and then of course accounts payable. Accounts payable amounted to 140,000. 140,000. So the share capital, of course, will be 276,000 equal to this one, 276. Okay, so let's check if our entries are balanced. So 40 plus 60 plus 96 plus 220. So this is 416. And then add this 2 also. 140 plus 276. Of course, 416. Ayan. So to record the net assets upon incorporation. Okay. Question number 2. So the question number 2, or rather scenario number 2, assume that the partners A, B, and C agreed to receive 3,500, 3,000, and 5,000 shares respectively. So in this case, the number of shares have been agreed upon. Okay. So number 3 question, how much should be credited to share premium and provide journal entries? As to the computation of the adjusted capital balances, it will be the same. So these are your final answers. We have 85,800, 75,800, 114,400. And then the entries on the partnership books will likewise be the same. So same entry, same entry. So the only difference would be the entries on the books of the corporation, because in this scenario the number of shares are specifically stated. Okay, so so let's compute again. So let's copy all these adjusted capital balances. So A, B, and then C. And then, of course, in total. Okay, so we have 85,800, 75,800, and 114,400 for a total of 276,000. Now, the number of shares would be as follows. Okay, so 3,500, 3,000, and 5,000. So 3,500, 3,000, and 5,000 shares. Number of shares. Okay, so multiply this by 20, by 20, by 20. So this will be your share capital. So 3,500 times 20. So this is 70,000. 3,000 times 20, of course, this is 60,000. And 5,000 times 20, 100,000. Okay, we get the difference of these adjusted capital balances and the share capital. So 70,000, 60, and 100. So the difference will be as follows. So this is 15,800. 15,800 also. And for this one, 14,400. When we compute for the total of these two, so this is 230, and of course this will be 46,000. Okay, so for the entries, so this will be your share premium, by the way. So for the entries, so similar, so we have cash, merchandise inventory, AR, and then PPE. So 40,000, 60,000, 96,000, and then 220,000. Accounts payable of 140, and then share capital amounting to 230,000 only. So actually you can compute this by adding all of this. So 3,500, 3,000 plus 5,000, that is 11,500 multiplied by the par value, so 20. Okay, and then share premium. So your share premium is the difference between the adjusted capital and the share capital, which is 46,000. So that's it for the entries and computation related to incorporation of a partnership.